Hey folks, Liquid here. As you probably know, I like to sell out of the money put options to generate monthly income. And normally this turns out to be $1,000 to $2,000 per month. However, February has been an outlier because I managed to earn over $7,000. So how did this happen? The answer is this: an increase in stock market volatility. Investors buy put options to protect themselves in case their stock falls in price. And the higher the implied volatility, the further the stock can potentially fall, which means the more money investors are willing to pay for that downside insurance protection. And this is great news for me as an option seller because I can come in and sell those put options to them and generate more money than usual. Because I get to set the strike price, I can make sure to only take assignment of the underlying stock at a reasonable price. Many investors are afraid when the stock market goes into correction territory, but you can use this as an opportunity to slowly pick up new stocks at discounted prices and buy into the fear, as well as use options income to offset your decreasing stock portfolio. And that's exactly what I've been doing over the last several weeks. Despite the total US stock market index being down month over month and the TSX up just 2.86%, my margin trading account is up 4.47%. Now, this does take a little bit of work, and I've spent about twice as much time managing my portfolio this month than usual, but I think the results are worth it, especially if you have a fairly large portfolio. Apparently, I'm not the only one who thinks this way. Zero Hedge recently tweeted that $1 trillion of put options are created every day, which is a record amount. So I'd like to share with you the decision process behind some of my options trades in February and talk a little bit about what my strategy is going forward into the next month. Let's start by looking at this spreadsheet, which I use to track all of my options trades. So today is February the 26th. I just had a really busy week trading options. And I'm just going to go over sort of from the beginning. I've talked about block before, and I was able to sell a put option with a strike price of $80, and I got $68 from that. Williams Sonoma, I made $275. This is like a home furnishing retailer, kind of like Winners. And usually it has a pretty low implied volatility, but right now it's pretty high at 54%, which is why I was able to make a nice premium from that. BlackRock, I've did a video before explaining how to sell options on BlackRock. And before in October, I set a strike price of 740, and I only made like $259 from that. But this time, I was able to make $819. And part of the reason is because the stock price is lower now. And the other reason is because the implied volatility is higher. And that pushes up the premiums because option buyers are willing to pay more money for that downside protection. So previously, I had my put option at 740 in October, and that expired worthless. This time, I'm able to choose 710 as my strike price. So not only do I get paid higher premiums, but if it gets assigned, I'm also going to buy the stock at a cheaper price. So I'm getting it at a bigger discount than from just a few months ago. So that's like the extra bonus of selling options when markets are going down. I made a nice premium from Netflix as well, 186 from Tesla, really good premiums from Coinbase. I sold this on February 1st. You can see the implied volatility is very high on Coinbase. At the time, the stock was trading at 198 when I sold it. And today is the 26th. So this is expiring next Friday on March the 4th. And the stock price is currently at 176, which is sort of like in between 150 and 198. Initially, there was an 11% chance the stock price could fall below 150. I think that's an appropriate amount of risk to take. Somewhere between like 7 to 12% delta would be a pretty good risk reward for at least for what I'm doing. And then for Meta, I decided to sell a bull put spread. And this means I will sell a put option with a strike of 200, meaning I will buy the stock if it falls below 200. And this is when the stock was trading at 239 at the time. But I also purchased a put option at 190, meaning I am covered if the stock goes below 190. As the owner of a put option, I can sell 100 shares of Meta at $190 no matter what the market price is. What this means is the most I can lose from this trade, like the worst case scenario, is I just lose $1,000 because you take the difference of these two and you times 100 shares. So I was able to sell this 200 put for 253, and I bought the 190 put at 160. So the difference between these two premiums is the spread that I made. So that's like less than $100 there. Um, And then Lightspeed and Alibaba, these are risk reversals. For Lightspeed, I closed. This is BTC buy to close, and then this is sell to close. So I sold these positions, and you can see I made a nice profit here from this risk reversal. I actually talked about this risk reversal, this particular trade in a previous video. So you can click on the corner link to watch that if you want to see what a risk reversal is. I also did one on Alibaba, which didn't turn out as well, but I'm pretty sure I can still make money off of that one eventually when it expires a few weeks from now. And I sold options for Triple Q, made some premiums, and I sold another block put. And then these teal colored pairs here, Wish, Etsy, PayPal, and C Limited, are options that I had before. And I don't want to take assignment of the shares because they're all in the money. So I've just decided to roll them forward. So as you can see, sometimes I make a little bit of a profit. I buy to close. So I buy my original Etsy put at 155 and I paid somebody 11.20, and then I sold at the same time another put at 145, and I'm basically rolling down my put. So eventually, either the stock price goes up and I'm out of the money, or I keep rolling down the put strike price until I'm eventually out of the money. So luckily, I was able to sell that at 11.98, which means this roll resulted in a credit of like $78. Sometimes that's not the case. In this situation with PayPal, I made a profit there. But then in this case with C Limited, I actually took a hit. So this is a debit because I bought it back at a more expensive price than I sold a new put at. And sometimes that can happen, especially if I, choose a lower strike there. But over the next month or so, I'm expecting to either take assignment of some of these that are in the money, or I'll just continue rolling them forward. Shopify is an interesting one here. I decided to sell a put spread on the news that the stock price dropped 19% because it was forecasting lower growth in the future. And I thought it was a good opportunity to buy some because it was at around $900 before, but now it's come down to like 732. So I wanted to sell a put option at 620. This was on February 16th. The stock price was trading at 732. So this it has to go down by 15% in order for this option to expire in the money. And I wanted to keep the duration short. So I chose an expiration date of February 25th, which was yesterday, which is only 9 days away till expiry. But because the implied volatility is so high, I was still able to get a nice premium from it. Now, because I wasn't sure if the stock price would continue to fall, so that's why I purchased a put option at 590 to protect myself in case the stock falls, really heavily to below 590. So I bought this put option and I paid somebody 226, and I sold this option at a higher strike price and basically made the difference there about $160. And then fast forward to February 23rd, I was looking at the Shopify put option at 590 that I bought. So this is the option that I own, and the price of this option was at 349. So it was more expensive than what I bought it for. And of course, the reason was because the price of Shopify fell from 732 to 648, which means it's more likely for the stock to actually reach the strike price of 590. I was looking at this and I thought, well, the stock would have to fall 9% from 648 to 590 within 2 days. What are the chances of that? Not very likely. So I decided to sell this option while I could and take advantage of that higher option price. So I basically sold it for 349 and I purchased it for 226. So I made a nice $100 or so profit there. But of course, looking back, that was a mistake because the very next day, on February the 24th, we all know what happened. Shopify's stock price dropped from 648 all the way down. At one point, it reached 590. So it actually hit that strike price before bouncing up a little bit. So whoever purchased my 590 put from me for 349, they're over the moon because they just made over $1,000 in profit if they were to sell and close their option position. So I basically sold this too early. I should have waited another day and protected myself against that downside. So now I have to focus on what should I do with my 620 strike put option that I sold, because right now the stock price was bouncing all over the place that day, but it was pretty much below my strike price, which means this option that I didn't think would be in the money is actually now in the money. And there's only 1 day remaining until expiry. So what I decided to do was roll this option forward instead of taking assignment. So at the time that I made this trade, the stock price was trading at 610 per share, which is below my strike price. And I had to pay over $1,900 to close this position. And then at the same time, I sold another put at a 590 strike. This is opening a new position. And I earned $3,000 from that. So I basically rolled it forward to a March 11th expiration, which is 2 weeks away, and I closed my current position. And the difference between the two, so about $1,100 is the credit that I made from this roll. And why would somebody pay me $3,000 for the right to sell me the shares at 590 when they can just sell it in the market today for 610? Well, it's because the implied volatility here, it went up to 93, and just a week earlier it was at 67. So that's a huge increase. And with higher implied volatility, it means higher premiums because people are anticipating a more choppy market in the near future. They think, what if next week the price of the stock falls to like 520 or 510? That's definitely a possibility. And if that's the case, then they are very willing to shell out, $3,000 for that downside protection. So fear can be a very powerful motivator for people to spend money. And the more implied risk there is to something, the more people are willing to pay to protect their investments. I also sold some puts on Mercado Libre, which is an e-commerce platform in South America. And then the very next day, the company released earnings and revenue growth was higher than expected. And it just did a gap up like that before dropping a little bit. But still, that's a huge boost to the stock price. So what that meant was the stock price, because it's trading at $47 higher than the day before, and because the option was about to expire in just 2 days, it meant that this option that I sold for 650 is almost worthless now. So what I did was I just closed out my position, buy to close. So I no longer have this option, and I made the difference there is my profit. So finally, I have my Tesla put option that I sold yesterday, and I recorded that transaction so we can go take a look. So I'm going to sell a weekly put option for Tesla. Normally, I would choose like a monthly expiration, but Tesla has a very high implied volatility and it also has a lot of volume. So selling weekly or bi-weekly put options, you would make more money over time because you're taking advantage of that time decay. So looking at the March 4th expiration, which is next Friday, 7 days away, and looking at the price here. So 640 looks to be a good, or even 650, because the stock price is at 800 today. So it's not very likely it'll go to 650 because, as you can see, this is 2.1 standard deviations, and the chances of it expiring in the money is just 4.5%. So I'm going to hover over this bid here at 650 and click. And this will take me to the order entry form, somewhere between 2.2 and 230. Let's go with somewhere in the middle and submit. So if this gets filled, I will be making $225. That's quite a large number for theta 0.72. So every day it's basically taking away that much value from the price of the option. So even as like time goes on today, this is getting lower and lower. So let's lower this down to $2.
Order filled.
Okay, so overall, that's over 5,000 US dollars in premiums, and I have some Canadian trades as well, but those aren't as interesting as the American companies. And in total, that's 7,400 Canadian dollars in net option premiums for the month of February. And other than just selling options, I've also been buying stocks as they get cheaper. Just last week, I purchased some PayPal, Block, and Meta shares, as I think they're very fair valued at this point. Now, I don't know if the stock market has bottomed yet, so it could go lower, but I am confident that gradually buying into the markets over the next few weeks will result in a lot of gains over the next year or so. So that's why I tweeted this last week, suggesting that stocks are likely to be much higher by next year. As long term investors, of course, it's always best to think in decades and not weeks. So even if I've missed the bottom by 10% or 20%, it probably won't make a big difference many years from now when these high growth companies are expected to make a lot more money and be way more profitable than they are today. So this is also my plan going into March. If the market continues to fall, I will be buying more stocks and at the same time selling more put options to take advantage of those higher than normal premiums. And by the way, I'm not doing anything new. In January, actually, as the markets were dropping, I uploaded a video explaining how to prepare for a potential correction. And I talked about building a watch list of the stocks you want to own and gradually buying on dips. I also mentioned basically the things that I brought up today, which is how lower stock prices will produce higher volatility and how I plan to use that to maximize my option premiums. So I've basically just taken all of the practical information from that video and applied it to my own portfolio in February, and this was the result. So if you haven't seen it yet and you want to better understand my initial reasons for why I like this strategy, you can click here to watch that video. Of course, nothing is without risk. Stocks could fall further after an option is assigned, for example, but I do think that a lot of stocks are cheap enough now that even if you do get assigned, you'll probably buy it at a pretty good price. Anyway, thanks for watching, and until next time.